If you have a Canadian-controlled private corporations and you have a capital gain, the taxation is a little complicated, but after watching this video, you should have a solid understanding of how it works. Hi, if you're new here, my name is Sam Kao. I'm a Canadian CPA. I used to work in one of the big four accounting firms as a tax manager, and now I run my own tax practice. I also teach bookkeepers and accountants how to prepare corporate tax returns. So in this video, we'll talk about what is a capital gain, inclusion rate, then we'll take a look at an example and see how $100,000 of capital gain is taxed. We'll talk about the tax on the taxable portion of the capital gain, how refundable tax works, timing of refundable tax, and then we'll take a look at the individual tax on the non-eligible dividends. And then we'll take a look at the other $50,000 that is not subject to tax. And then we will compare taxation of capital gains on individual level versus corporate level. And then we'll take a look at another example, but this time it's $1 million of capital gains. And then we'll talk about the planning opportunity. So let's start with a definition of a capital gain. You have a capital gain when you purchase something that is a capital asset, such as stocks, real estate, collectibles, at a certain price, and then you eventually sell it at a higher price. So let's go here. There are a few things that we need to know about proceeds of disposition. So this is a price that we're selling our asset for, then less adjusted cost base, and then less expenses and outlays. So for example, let's say we bought a rental property for $100,000. So $100,000, then we made some upgrades, renovation, and we spent another $2,000. And then we eventually sold it for $150,000. And then we spent $2,000 in legal fees. So then our capital gain is $150,000 less $102,000 less $2,000. So this is our capital gain. That capital gain is subject to tax, but it gets taxed in a very unique way. In order to know how the taxation works, we need to understand the inclusion rate. Similar to individuals, corporations have an inclusion rate as well, and it's the same. Inclusion rate means that a portion of your capital gain will be subject to tax. As of right now, the inclusion rate is 50%. And just a side note, the government did want to increase the inclusion rate to 66.67%, but they scrapped the idea, so we're now back to 50%. So that just means that inclusion rate is 50%. So then the taxable portion of the capital gain is $46,000 times 50%, and then non-taxable portion of the capital gain is $46,000 less $23,000, which is the same in this case. So let's take a look at this example. Let's say we purchase an asset for $100 and then we're selling it for $100,100. Our capital gain should be $100,000. So let's put it here. The proceeds of disposition is $100,100. Our cost is $100 and we did not incur any expenses. So this one is zero. So in this case, the inclusion rate is 50%, then the taxable portion of the capital gain is $50,000 and the non-taxable portion of the capital gain is also $50,000. So this one will be subject to tax, which we'll discuss in a bit. The other $50,000 is not subject to tax and it goes into this notional account called Capital Dividend Account, which we will discuss in a bit. All we need to know at this point is that this $50,000 is not subject to tax, which is awesome. So the next, the $50,000 is subject to about 50% tax rate on investment income. So this one is subject to tax on investment income. As you may know, Canadian-controlled private corporations pay 9 to 12% on active business income if they're eligible for the small business deduction, or about 27, 28% if they exceed that small business deduction threshold. But when it comes to investment income, the tax rate is a little bit different, and it's about 50%. It's a little bit different depending on your province, but if you go to Google and you search year-end tax planner 2024, PwC, you will get to this page. Then you just click year-end tax planning checklist, and then you can download the full PDF. It's a very good document. You can go through it. Usually when you open, you will see this, but scroll all the way down, and then you will have this table, the combined federal and provincial corporate income tax rates. So let's say if you're in Manitoba, tax rate on income that is eligible for the small business deduction is 9%, the general rate is 27%, and tax on investment income is 50.67%. If you're in Ontario, it's 50.17%. So let's take Manitoba as an example. In this case, it's 50.6666%. That's the actual tax rate, rounded up to 50.67. So then our tax is this. But, and you may think to yourself that is crazy, but this tax has two components to it: permanent tax and refundable tax. The permanent tax is 20%. So 20% times $50,000. So this tax goes to the government and you will never see it again. The refundable tax is 30.6666%. Just make some edits here. And we take that times $50,000. So this is a refundable tax. So this refundable tax goes into a pool called non-eligible refundable dividend tax on hand. So go into NERDTOH. And it's a temporary tax, and you will get this back when you issue a dividend. So how refundable tax works: for every $1 of a non-eligible dividend you pay, you will get back 38.33% in a dividend refund up to the balance. So what does it mean? So in this case, our NERDTOH balance is $15,000, right? And if we pay a non-eligible dividend from this corporation, let's say $1, we will get a dividend refund equal to 38.33%. If we pay, $10, we'll get $3.8 back. If we pay $10,000, we will get $3,800 back. If we pay $40,000, we'll get the full balance back. But if you pay more than that, let's say $50,000, you will not get $19,000 back because it is limited to the balance of NERDTOH. So it's the lesser of the NERDTOH balance and then this dividend refund. So in this case, in order for us to fully get this money back, we need to issue $40,000 of non-eligible dividend from this Canadian-controlled private corporation to a shareholder. But you may have a question, like, we don't have enough cash, right? I'm going to ignore the actual cash that the corporation has and the other $50,000 that was not subject to tax. But if we look at the cash balance, we had $50,000 of taxable capital gain, and we have to pay tax of $25,000. So we only have $24,667 left. How can we issue $40,000? Well, turns out you can issue this dividend. And by declaring $40,000 of non-eligible dividends, the government will give this money back to you. And so when you combine the cash that is in the corporation plus the dividend refund, you'll get $40,000. Timing of refundable tax. If you have a capital gain and then you pay out a dividend in the same year, you will not have to pay this refundable tax. So that means that if you trigger this gain, let's say in 2025, and then you pay $40,000 of dividends in 2025 as well, you won't have to pay this tax because it's in and out. But if you have a capital gain in the first year, so let's say in 2025, and then you decide to pay a dividend in the third year, let's say in 2027, you do have to pay tax in the first year. So in 2025, we had to pay this $15,000 to the government, but we will get it back in the third year in 2027 when we pay this $40,000. So in the meantime, this $15,000 will be sitting in the government's bank account without accruing any interest. And this question I get a lot. Yes, you can carry forward NERDTOH balance indefinitely. So the next part is, let's talk about individual tax on non-eligible dividends. So once we pay this $40,000 of non-eligible dividend, we also need to pay personal tax. The tax rate depends on your bracket. If you're in a high tax bracket, obviously you're going to pay higher taxes. If you're in a lower tax bracket, you will pay lower taxes. You can be strategic with this. Maybe you don't want to pay out a dividend in a high income year. If you have low income that year, you can pay out and take advantage of a low tax bracket. So what happens to the other $50,000 that is not subject to tax? The other $50,000 can be paid out as a capital dividend, and that dividend will not be subject to tax. This process is a little bit more complex. You do need to calculate the capital dividend account balance, which is a notional or a fictional account that tracks amounts that increase or decrease the balance. So when you have a capital dividend account, there are a few components that increase this balance and some components decrease this balance. For example, non-taxable capital gain, non-taxable capital loss. This will decrease. Capital dividend received less capital dividend paid, insurance proceeds. Assuming that before this transaction, the CDA balance was zero, and this is the only transaction in the year, this gain will increase our CDA balance by $50,000, which means we can pay $50,000 of capital dividend to a shareholder, and that dividend will not be subject to personal tax. Now, the process of paying a capital dividend is not very simple, so always talk to an accountant or a tax lawyer. You do need to file an election and some other forms to the CRA. So now let's compare taxation of capital gains on individual hands and in a corporation. So I will put scenario number 1 and then option 1, individual. And let's say we have a capital gain of $100,000 less personal tax. So to calculate the personal tax, we need to open a tax calculator. I highly recommend using taxtips.ca. You can just Google it, taxtips.ca calculator. This is probably the best free online tax calculator. You can also find the link here. So let's assume we are in Manitoba, and let's scroll down here. And let's put capital gains in excess of capital losses, $100,000. So then our tax will be $8,600. So let's go back to our Google Sheet and put amount here. So then our after-tax cash is about $91,000. Option 2, corporation. So capital gain, $100,000 less permanent tax at 10%, cash available for distribution. I'm ignoring the refundable taxes because we're going to pay out all the non-eligible dividends. So then we can pay capital dividend, which is $100,000 times 50%. And then non-eligible dividend, $40,000, just like we have here. So then less personal tax. So we don't have to pay any taxes on capital dividends. And for non-eligible dividends, let's go back to this calculator. Let's delete this. Canadian non-eligible dividends. Let's put $40,000 here. Copy this. So our after tax cash is 50 plus 40 less 3,000. So obviously this option is better. In this case, realizing a capital gain personally is better, but that's because our tax system is not perfect. So let's take a look at the second example where instead of $100,000, we realize $1 million of a capital gain. So I'll copy all of this, change this to scenario number 2, individual, $1 million, and let's change this. Let's go back to the calculator and put over here, 1 million. So this is our tax, $263,000. And then option 2, corporation, capital gain is 1 million. Cash available for distribution is $900,000. This is after paying permanent tax. And then the capital dividend is $500,000. We don't have to pay tax on that. And then non-eligible dividend is $400,000. So let's go here and put non-eligible dividend. Copy $153,000 less personal tax. So in this case, this option is actually better. We're going to pay $10,000 less in taxes. And one thing I will say that this is specifically from Manitoba. If you run numbers for Ontario, Alberta, British Columbia, or other provinces, you may come to a different conclusion, right? But the point is, it's not very material. But can we actually do better than this, right? And that takes us to the last part, planning opportunity. With the corporation option, you don't have to pay out $400,000 of non-eligible dividends right away. You can pay, let's say, $100,000 per year, and that will lower your overall taxes. So what I mean by that, let's say in year 1, year 2, year 3, year 4, dividends paid is $400,000 times 4 divided by 4, and then just copy across, tax paid less personal tax paid. And we can go to the calculator again and put $100,000. So then our annual tax is only $19,000. Then let's have a total column. So our after-tax cash is $500,000 plus $400,000 less $76,000. So compared to option 1, compared to option 2. Less this, and then less this. As you can see, by spreading this $400,000 over 4 years, because we don't really have to pay all of it at once, we were able to reduce our taxes by $77,000 to $87,000 in taxes, which is amazing. And that's it. So this video did not cover alternative minimum tax. It's a nuisance that we had to deal with, but essentially when you have a capital gain personally, you may have to pay alternative minimum tax, which makes option 2 even more desirable. As always talk to your advisors, accountants, and lawyers before you do anything. This is just for educational purposes only. And if you like this video or have any questions, drop a comment below and I'll respond to as many as I can. Make sure to subscribe for more videos like this.